In today's video, I wanted to see if I could break down the idea and excitement behind dividend investing. My goal of this video is not only to give new investors a great foundation of information, but also to make sure they have knowledge to avoid common mistakes. For the experienced investors here that frequent the channel, I'm hoping to clear up some confusion I hear in the dividend world and maybe even give you the information to be a better investor as well. But with all that being said, let's dive right into the episode. First things first. What are dividends? Dividends, simply put, are earnings from a company that they choose to split with their shareholders. When a company earns a profit, it can choose to reinvest that money back into the business, or it can distribute a portion of those earnings to its shareholders as, you guessed it, a dividend. Dividends are most commonly paid out on a quarterly, which is every 3 months, or monthly basis, but they can also be paid out on a yearly, semi-annually, or even weekly basis. The amount paid out can vary depending on the company's performance and financial situation, which is why it's key to invest in quality companies. For companies, dividends are one way they can reward their shareholders, and for shareholders, dividends can provide another source of regular income and be a key piece to their retirement planning. Now that we know what dividend investing is, let's discuss some of the benefits of dividend investing. First up is regular income. Dividend stocks can provide a steady stream of passive income to investors. Since dividends are typically paid on a regular basis, investors can rely on the income to cover their expenses or reinvest it to grow their portfolio. Lower volatility. Dividend stocks tend to be less volatile than non-dividend stocks. This is because companies that pay dividends are often mature, stable, and financially strong. The regular income provided by dividends can also help to cushion against market volatility. Long-term growth potential. Dividend investing can provide long-term growth potential, as many dividend-paying companies have a history of increasing their dividends over time. This can help offset the impact of inflation and provide a growing stream of income for investors. Portfolio diversification. Dividend stocks can provide diversification benefits for investors, as they can be found across different sectors, industries, and geographies. This can help reduce the risk and volatility in a portfolio. Tax advantages. In some cases, dividend income can be taxed at a lower rate than other types of investment income. This can provide tax advantages for investors who rely on dividend income for their retirement and other financial goals. Now let's quickly go over some popular dividend metrics and terms. First, we have dividend yield. This is the amount of dividends paid out per share of stock divided by the stock price. It represents the annual return on your investment if you were to buy the stock at its current price and hold it for a year. Dividend payout ratio. This is the percentage of a company's earnings that are paid out as dividends to shareholders. A low payout ratio indicates that the company is retaining more earnings for future growth or other purposes. Dividend growth rate. This is the rate at which a company's dividend payments have increased over a period of time, typically measured on an annual basis. A high dividend growth rate may indicate a healthy and growing company. Dividend ex dividend date. This is the date on which a stock begins to trade without the dividend. If you buy a stock on or after the ex dividend date, you will not receive the next dividend payment. Record date. This is the date on which a company determines which shareholders are eligible to receive the next dividend payment. You must own the stock on the record date to be eligible for the next dividend. Dividend payment date. This is the date on which a company pays its dividend to shareholders who own the stock on the record date. A special dividend. This is a one-time payment that a company makes to shareholders in addition to its regular dividend payments. Special dividends are often paid out when a company has excess cash on hand, or when it wants to reward shareholders for a particularly successful quarter or year. Dividend reinvestment plan, also known as the DRIP. This is a program that allows shareholders to automatically reinvest their dividends in additional shares of the company's stock. DRIPs can help investors compound their returns over time by buying more shares at a potentially lower cost than buying them on the open market. Fractional shares. Partial shares of a stock that, if allowed by your brokerage, will allow you to use amounts as little as $1 to buy your way into high-priced stocks that may have otherwise been out of reach. Qualified dividend. A qualified dividend is a type of dividend that is subject to lower tax rates than ordinary income. To be considered qualified, a dividend must be paid by a U.S. corporation or a foreign corporation that meets certain requirements and must be held by the investor for a certain period of time. Non-qualified dividend. A non-qualified dividend is a type of dividend that does not meet the criteria for qualified dividends and is taxed at the investor's ordinary income tax rate. Dividend cut. A dividend cut occurs when a company reduces or eliminates its dividend payment to shareholders. This can be a sign of financial distress or a shift in the company's priorities. Dividend yield on cost. The dividend yield on cost is a measure of the yield that a shareholder receives based on the original cost of their investment. It is calculated by dividing the annual dividend payment by the original cost of the investment. Total return. Total return is the measure of the overall return on an investment, including both capital appreciation and dividend payments. It is a more comprehensive measure of the investment performance than just looking at the stock price changes or dividend yield alone. Taking what we learned about the metrics and terms, we can use that to find our dividend stocks. Step 1 on how to find a dividend stock is determining the criteria you want to use. These will be metrics that you understand and are valuable to you and important to your success as a dividend investor to help you meet your goals. They could include things like a stock that pays dividends for a certain number of years of a row, the growth rate of the dividend, and having a payout ratio under a certain percentage. Step 2 is to choose your stock screener. While most brokerages you have your account with will have a stock screener, some do not. For those that do not, there are always places like Yahoo Finance, FinViz, and Seeking Alpha that you can use for free to put in the criteria you nailed down in step 1. Step 3 is to review the results and narrow down the list. Once you have generated the list of stocks that met all of your initial criteria, most will begin to look at other important factors that you might not have filtered the initial list by that are also important, like the company's financial and historical performance. Do tip. In my experience at this point in my journey, this process is not only very important, but it's also a good idea to be very picky in this step. You do not need to have thousands or even hundreds of stocks that met your criteria. Having too many stocks show up on this process can be overwhelming to review and might be a sign that your criteria is too loose. Remember, there's no minimum or maximum number of stocks that make up a good portfolio, and even your favorite investors started somewhere, so starting small might be the easiest path here so you don't bite off more than you can chew. There are several different categories of dividend stocks, each with their own risk, return, and tax implications. Some of the most common categories are blue chip. These are stocks of large, established companies with long histories of paying dividends. They tend to be less volatile than other stocks, making them a lower risk investment. Blue chip dividend stocks tend to have lower dividend yields than other type of dividend stocks, but they can offer steady income and growth potential over time. High yield dividend stocks. These are stocks with dividend yields higher than the average of the broader market. High yield dividend stocks can be riskier than other types of dividend stocks, as they may have higher debt levels, weaker financials, or other issues that make them more vulnerable to market downturns. However, they can also offer higher potential returns for investors willing to take on the added risk, or those that are closer to retirement and need the income from the investments sooner rather than later. Growth stocks. These are stocks of companies that are expected to increase their dividends over time. Dividend growth stocks can offer both income and capital appreciation potential, as investors can benefit from both the dividend payments and the stock price appreciation as the company grows. Real estate investment trust, also known as REITs. Companies that own and operate income-generating real estate properties. They are required by law to pay out most of their taxable income to shareholders as dividends, which can make them attractive to investors seeking regular income. However, REITs can be sensitive to changes in interest rates and the real estate market, which can affect their stock price and dividends. In terms of tax implications, qualified dividends, which include most dividends from U.S. stocks, are taxed at lower rates than ordinary income, making them a tax-efficient source of income for many investors. However, certain types of dividend income, such as those from REITs or foreign stocks, may be subject to different tax rates or withholding requirements. It's important for investors to understand the tax implications of their dividend investments and consult with a tax professional if necessary. Now armed with all the information you know, let's see how to create a dividend portfolio. Step 1 is to determine your investment goals. Do you have time to let this portfolio and the earnings grow? If so, how long? Do you need the money generated by the account soon? If so, how soon? What is your risk tolerance? Do you have the stomach for large jumps and drops in the market, or do you like the slower and steady growth? Step 2 is selecting dividend stocks. Using the info from step 1, in addition to the metrics that you understand and value for your filtering criteria, you can then begin to pick some stocks across different sectors and industries to reduce risk. Step 3 is to balance yields. Balancing the yields of your dividend stocks is important to achieve diversification and manage risk. Investing solely in high yield stocks may increase your income, but also expose you to greater risk. Consider a mix of high-yielding and lower-yielding stocks to balance your portfolio and align with your investment goals. Step 4 is to monitor your portfolio. Regularly monitoring your dividend portfolio is important to ensure it stays balanced and aligned with your investment goals. Rebalancing your portfolio periodically can help you adjust your holdings to reflect changes in your risk tolerance, market condition, and investment goals. Step 5 is to consider tax implications. Dividend income is subject to different tax rates than ordinary income, so it's important to understand the tax implications of your investments. Consider holding dividend stocks in a tax advantage account, such as an IRA or 401k, to maximize your tax efficiency. Speaking of considering tax implications, let's cover a few of the main tax situations with dividend investing. Taxable income. Dividends are generally considered taxable income, which means that investors must report them on their tax returns and pay taxes on them. However, the rate of tax applied depends on the investor's income bracket and the type of dividend. The first type of dividend is qualified dividend. Qualified dividends are taxed at a lower rate than ordinary income tax rates. To be considered qualified, the dividend must meet criteria set by the IRS, which is a dividend paid by a U.S. corporation or qualified foreign corporation, and must be held for at least 60 out of a 121-day period. Do tip. There are a bunch of articles and videos out there that do a great job of making dividend dividends sound tax inefficient, but the fact of the matter is, as you can see here, a portfolio full of qualified dividend payers is far more tax efficient than earned income. And while the federal tax income brackets are changed every year, the qualified dividend tax rates have only been changed 5 times in history, and the last time was in 2003. Non-qualified dividends. These are dividends that do not meet the criteria set by the IRS to be considered qualified dividends, as we just discussed. These dividends received are counted as regular working income and taxed just like your normal income. Do tip: using a site like dividend.com will be able to show you if a company offers a qualified or non-qualified dividend. Capital gains tax. This is a tax on the profit earned from the sale of an asset. The tax rate applied depends on the investor's income tax bracket and how long they held the asset before selling it. Short term is for investments held less than 1 year, and they are taxed at your normal income tax bracket, while long term is for holdings over 1 year, which is taxed at that qualified dividend tax bracket outlined previously. It is important to note that there are some expectations and special rules that may apply to capital gains taxes, such as the wash sale rule and the exclusion of certain capital gains from taxation. Additionally, some states also levy their own capital gains tax in addition to the federal tax. Investors should consult with a tax professional to fully understand the tax implications of capital gains and to develop a tax-efficient investment strategy. Just like any form of investing, dividend investing has its own risk and challenges. 3 major risks include interest rate risk. When interest rates rise, dividend-paying stocks may become less attractive to investors compared to fixed income securities such as bonds. This can lead to a decrease in the stock price and potentially lower dividend payments. Market volatility. Dividend-paying stocks can be subject to the same market volatility as non-dividend-paying stocks. During times of market downturns, dividend-paying stocks can experience significant price declines, potentially leading to a reduction or suspension of dividend payments. Dividend cuts. Companies may reduce or suspend their dividend payments due to financial difficulties or changes in their business strategy. This can negatively impact the stock price and potentially result in lower overall returns for investors. Just as important as knowing the risk and challenges is knowing how to avoid them. 3 ways to do that include diversify. By holding a diversified portfolio of dividend-paying stocks, investors can reduce their exposure to any one company or sector. This can help mitigate the impact of dividend cuts or market volatility. Focus on quality. Look for companies with a history of consistent dividend payments and strong financial position. Companies with a strong balance sheet and cash flow are more likely to continue paying dividends during times of market volatility or economic downturn. Stay informed. Keep up to date with the companies in your portfolio and monitor their financial performance. This can help you spot potential risks such as declining earnings or rising debt levels that could impact your dividend payments. One of the last things I want to leave you with are 5 tips to be a successful dividend investor. Number 1, reinvest your dividends. Reinvesting dividends can help increase the compounding effect of your investments as your dividends are used to purchase additional shares of the stock. Over time, this can significantly increase your returns and help you accelerate the growth of your portfolio. Number 2, stay disciplined. It's important to stay disciplined and stick to your investment strategy even during times of market volatility. Avoid the temptation to make knee-jerk reactions based on short-term market fluctuations and instead focus on the long-term prospects of the companies in your portfolio. Number 3, focus on the long term. Dividend investing is a long-term strategy, so it's important to have a long-term mindset when selecting investments. Look for companies with strong track records of consistent dividend payments and history of financial stability. These type of companies are more likely to continue paying dividends and growing their payouts over the long term. Number 4, consider total return. While dividend income is an important component of dividend investing, it's also important to consider the total return of your investments, which include both capital gains and dividend income. Focusing solely on dividend income could lead to missing out on potential capital gains. Number 5, practice diversification. As with any investment strategy, diversification is key to mitigating risk. Diversify your dividend portfolio by investing in a variety of companies across different sectors and industries. This can help protect against the risk of individual companies reducing or suspending their dividend payments. By following these tips, you can increase your chances of success and achieve your long-term financial goals. Thank you so much for joining me today to explore the world of dividend investing. We covered a lot of ground from the basics of dividends to the risk and challenges of this investment strategy. By focusing on quality, staying disciplined, and taking the long-term approach, dividend investing can be a powerful way to generate income and grow your wealth. I really hope that everybody from the rookies to the pros was able to gain something from this video. If you did, please consider leaving a like on the video as it helps others find the video and the channel. And then make sure you guys are subscribed and ringing the bell to stay up with all my future dividend related content. If there's anything I missed or questions you have, please leave those in the comments down below. And if you happen to miss my most recent video covering the Power 5 stocks of the week, check that out right here. But until next time, see you.